what is given here. All right. Yeah. It says the following details have been gathered for the 2005 EVA calculation. The operating profit of the company was around 3175. Remember what is operating profit? Operating profit is profit before interest and tax, right? This include depreciation charge of 1780. So depreciation actually means this is basically the accounting depreciation. So what we have learned with respect to accounting depreciation, we cannot include it in our profit statement. So we have to exclude, we have to add back economic accounting depreciation, right? Then it says amortization charges of 95 million in the year have been incurred. So that is again an expense which we don't believe that exists. The corporation tax is around 25%. Tax of 694 million was paid in the year. The company has spent 90 million this year and each of the previous 10 years so long on the long-term brand building, right? So in this year, company has paid 90 million expenditure, and for the last 10 years, company is continuously paying 90 million as an expense for brand building, and that is basically something which you can consider to be the advertisement expenditure, because that is somehow you are improving your product, right, through advertisement. The economic depreciation for the year estimated to be 1907, right? So this is economic depreciation that has also, that is also adjusted in P&L. This year and each of the previous 10 years, economic depreciation has included 10 million written down value, write down of the value of brand building. So we have also, if we are adding that advertisement expense here, then we have to charge economic depreciation too. And how we are going to do that, we will see in our EVA calculation. Research and development expenditure was 705 million, right, in the period, leading to an economic asset of 4233. Economic asset means what? That is something which is not subject to accounting asset, but this is something which is actually related to economic value added. Interest paid is 213 million. Capital employed during the period is given. Pre-tax cost of capital, equity, debt, everything is given, right? Now let's start with the calculation of economic value added, right? We usually start from what? We usually start from operating profit. Let's forget it, Excel. Let's do it here. Operating profit is 3175, right? And then you have to add back accounting depreciation, right? You have to add back accounting depreciation. Accounting depreciation was 1780, right? And then there are amortization charges that also you have to add back. Amortization, because we believe that amortization is actually the idea of your own expense. That is something which not really exists. Something exists is the economic depreciation, or something which exists is actual wear and tear in your allowances, right? So that's basically the issue. If there is actual reduction in the value of something, we are going to deduct it, right? So amortization in this case is usually related to goodwill, which we don't believe, because we think that this is just a mere estimation of company. So we just need to add 95 million back. We will add this back, and the company paid tax of 694 million. So tax paid during the period. You may pause this video and try to do it at your own if you got the concept of economic value added. The company has spent 90 million this year and each of the previous 10 years, right? So this year company paid 90 million. So we have to add brand building expense, right? And that is around 90 million. We have to add that back. And then economic depreciation of this year estimated to be 1907. So economic depreciation is 1907, right? That we have to deduct. And this year in each of the previous 10 years, economic depreciation has included 10 million written down value of the value of brand building. Now just try to think whether this 10 million should be adjusted in this PNL or not. I mean, do we really need to adjust this 10 million? You may pause this video and think for a while. Do we really need to adjust this 10 million? No. Why? Because it says that this year and each of the previous 10 years, economic depreciation has included a 10 million written down value. That means this economic depreciation actually includes 10 million of 10 million economic depreciation, which is actually connected with the written down value of the brand building, right? So that has already been included in 1907. But in case if this expense has not been the part of 1907, we have to in that case we have to deduct this expense from this accounting depreciation from this profit and loss account, right? Research and development expenditure is around 705 for this period. So research and development is 705. We need to add that expense back to. And then interest expense, tax paid on tax savings on interest, loss of tax on interest, that we have to calculate. 213 times what is the tax expense? 25%. That is 53.25, right? So right, and what else? Nothing else. We need to deduct this part as well. So let's see what we can do. 3175 plus 1780 plus 95 minus 694 plus 90 minus 1907 plus 705 minus 53.25. That makes 3190.75, 3191 approx. This is what this is. Economic profit, right? And now we have to adjust the capital employed, right? We have to adjust the capital part. So how can we adjust capital part? We have to start from the opening capital. Opening capital is 19404, and then we have to add not operating profit, not amortization, not corporation tax. Yeah, this part. We have to adjust 90 million expenditure has been done this year and each of the 10 previous years. So here we have to adjust what advertisement expense has been charged in the previous 10 years, right? And how you are going to do that? You have to do that adjustment in retained earnings, because you cannot adjust what you want to adjust for the profit and loss account for the past 10 or 12 years, right? So that has to be done in retained earning part, and retained earning is a part of capital employed, right? So since we are dealing with the opening capital, then we have to adjust what? We have to capitalize the research and development, we have to capitalize the brand building concept, and that is for last 10 years, previous 10 years, multiply by 90. 10 times 90 is 900, so we have to add this 900 back, right? And then it says that corporation tax, the economic depreciation is given, nothing has to be done. This year and each of the previous 10 years, economic depreciation has included. So that means what? That means this asset which we have already capitalized is subject to some amortization too, right? Economic depreciation, not amortization. We have to economically depreciate this asset too. And how we can do that? See, if we have applied economic value added from the start of the project from 10 years, then in each year we would have deducted this 10 million from our profit and loss account as an economic depreciation. So now we have to adjust the 10 million which should have been charged in the previous 10 years, right? But since we don't have any other, we cannot adjust it in this year. We have to adjust this 10 million also in the retained earning part. But in that case, since this is a deduction, so we have to reduce our retained earning. So now what we are going to do, we are going to charge economic depreciation for the last 10 years, right? Which is 100 basically. So in a nutshell, if I want to explain it in a proper manner, so it can be explained in like in this way, that in each year we have to add back this 90 million, in each year we have to deduct 10 million economic depreciation, that result in 80 million adjustment, right? So that 80 million multiplied by 10, that is basically this part, 800 part, and this 80 multiplied by 10, or this 900 minus 100, that means the same. Do we have to adjust any other thing? Yes, research and development expenditure of 705 million was incurred in the period, and leading to an economic asset of 4233 at the year end, right? So how much we have to adjust? Try to think. We have to adjust this 4233 minus 705. Why we are deducting 705? Because if we capitalize 705 million, then by the year end the asset value will be around 4233. But the point is, we are not taking year end capital, we are taking opening capital. So we have to adjust capital which has been at the starting of the year, right? So we will not consider this part, we will consider 4233 minus 705, that is equals to 3528, right? So we will adjust 3528 as a research and development capitalization. So this means what? 19404 plus 800 plus 3528, right? 23732. 23732. Right? This is what? This is adjusted capital. Right? So what we have to do here now is we just have to calculate the economic value added, and that is very simple requirement. You guys can do it at your own too, but let me do this here. You just need to calculate that you just need to calculate that Alright, so you just need to, I'm unable to scroll it actually, yeah. So we will start from economic profit, right? You can do it at your own as well. Economic profit 3191, and charge of and capital charge, right? Capital charge will be let me try to check this. Equity part is 12%, so 12 times gearing is 55%, that was equity is 55%, plus 3.8 times 0.75 times 0.45, that makes 7.88%. 7.88% of 23732, right? So this is basically the positive EVA which has been generated. So that means what? That means company is actually, the projects are actually creating value. The company is actually creating value for the shareholder, because positive EVA or actually means that that company is generating enough profit, enough return, which is more than the cost of capital, right? So this is basically the EVA part.